Welcome back to the Price Action Trading series. This is video number 11 and I'm your host, Trader D. In this video, we're diving into one of the most important aspects of trading, market trends. We'll study what a market trend is, how to identify it, and most importantly, how to use it to find high probability trade opportunities. So, let's get started. So what is a market trend? First, let's define a market trend. A trend is the overall direction in which the market is moving, either upwards, a bullish trend, downwards, a bearish trend, or sideways, a ranging market. Understanding the trend helps you align your trades with the market's momentum, increasing your chances of success. How to identify market trends? So how I find the trend? Here are 3 simple steps. Step 1. Look at higher timeframes. Always start by analyzing the bigger picture. Check daily or weekly charts to see the overall direction before zooming into smaller timeframes. Step 2. Use trend lines. Draw trend lines by connecting higher highs in an uptrend or lower lows in a downtrend. Trend lines act as a visual guide for where the market is heading. Step 3. Moving averages. Use moving averages like the 20 or 50 EMA. If prices are above the moving average, it's likely an uptrend. If below, it's a downtrend. These methods combined will give you a clear understanding of the current market structure. Now combine these methods. Let's find market trend of gold, oil, and BTC. This is the daily gold chart, and we're going to analyze its trend. You can clearly see in the chart, there is a consistent pattern of higher highs and higher lows. This signifies an uptrend, where buyers dominate the market. The price action shows strong momentum upward, with bullish candles green outnumbering bearish candles red. This is a classic bullish trend, indicating demand for gold is rising. Now let's find the oil trend. The chart begins with a clear downtrend, as indicated by the formation of lower highs and lower lows. The dominance of bearish candles, red in this section, shows strong selling pressure. This trend reflects decreasing market demand, pushing the price downward over time. Now look at BTC. At the start of the chart, the price moves in a narrow range with relatively small candles, indicating a period of consolidation. This phase suggests that the market was accumulating strength before a breakout. The breakout signifies that buyers are in control, and the price starts forming higher highs and higher lows. As the trend progresses, the candles become larger, indicating a surge in buying pressure. This reflects strong bullish momentum, often driven by high demand or positive sentiment in the market. Now that you've identified the trend, how do you trade it? Rule number 1. Buy in an uptrend. When the market is trending upward, the best time to enter is during a pullback, a temporary price correction that gives you an opportunity to buy at a better price. But here's the key: don't rush in, be patient and watch for confirmation. Look closely at volume and candlestick patterns. When the price pulls back to a key support level, such as a trend line, or a moving average, wait for a bullish candlestick pattern like a hammer, or an engulfing candle accompanied by strong volume. This combination signals that buyers are stepping back in, and the trend is likely to resume. Entering at this point positions you as a smart and profitable trader. Aligning your trade with the momentum of the market. Always remember to set your stop loss below the support level to manage your risk. Rule 2. Sell in a downtrend. In a downtrend, the strategy is reversed. Wait for the price to pull back to a resistance level, such as a previous support that has turned into resistance, or a moving average acting as a ceiling. As the price approaches resistance, look for bearish candlestick patterns like a shooting star, or bearish engulfing candle combined with higher volume. This indicates that sellers are regaining control, and the trend is likely to continue downward. Place your trade accordingly, and set your stop loss just above the resistance level to protect against unexpected reversals. Rule 3. Avoid ranging markets. Trading during sideways or ranging markets is risky because the lack of momentum can lead to false signals and choppy price action. Instead, focus on trending markets where the momentum is clear. Trends give you the best chance to ride the wave and maximize your profits. Practical tips for better trend trading. Here are a few pro tips. Number 1. Follow the trend. Don't fight with trend. One of the biggest mistakes traders make is trying to predict when a trend ends. Instead, focus on trading in the direction of the trend until there's clear evidence of a reversal. Remember, the trend is your friend until it bends. Number 2. Wait for confirmation. Patience is key in trend trading. Don't jump into trades prematurely. Wait for confirmation, such as a retest of support or resistance levels, bullish or bearish candlestick patterns, and strong volume signals. The more factors aligning with the trend, the higher your trade's probability of success. Number 3. Set realistic targets and stop losses. Always trade with a plan. Set realistic profit targets based on key levels like Fibonacci retracements, previous swing highs or lows. Use stop losses strategically to protect your capital. A good rule of thumb is to ensure your risk-to-reward ratio is at least 1 to 2. Number 4. Watch for trend reversals. Trends don't last forever. Learn to recognize signs of reversal like double tops, double bottoms, or a break of key trend lines. If the trend shifts, adjust your strategy or sit on the sidelines until a new trend emerges. Number 5. Stay disciplined. Emotions are your biggest enemy in trading. Stick to your trading plan, avoid overtrading, and never chase the market. Discipline and consistency are what separate successful traders from the rest. By applying these practical tips and sticking with the trend, you'll not only improve your trading accuracy, but also build the confidence to execute trades like a pro. Remember, trading isn't about predicting, it's about reacting smartly to what the market shows you. Thanks for watching, and as always, trade smart, stay disciplined, and I'll see you in the next video.